Hello everyone, it's Larry East with your weekly rate update for the week of October 1st. Before we get into it, I want to do a disclaimer, a warning message if you will. I don't plan on using any foul language or telling any dirty jokes, but it was not a fun week in the mortgage markets. It was downright ugly. So let's jump into the news. The big news item this week was the unemployment report, or the employment report for September. The report was a little bit mixed. We had less than expected jobs created in September, but they increased the number of jobs that were created the prior 2 months, more than making up for the loss we saw in September. So that ended up being good. The unemployment rate was the big news. The unemployment rate dropped to 3.7%, which was the lowest unemployment rate since December of 1969. For reference, the Jackson 5 was on the Ed Sullivan Show in December of 1969. So if that meant nothing to you, it just means it was a long, long time ago. And if it meant something to you, you know that was a long time ago. So that's the jobs report. Inside the jobs report, the component that is closely followed by mortgage investors because of its inflationary implications is the average weekly earnings. Now this jumped 3.4%, which spooked investors because, as we've spoken about, inflation is a nemesis of mortgage rates. Anytime investors think we might see an increase in inflation, they drive rates higher to compensate for that. Wednesday of this week was an ugly day. It was the worst single day we've seen in many, many years as far as how much rates increased that day. So why are rates increasing? What's going on? It's the same story we've been speaking about, just a lot of things are really coming together. Let's recap. We've got the Federal Reserve. We've spoken about the Federal Reserve several times. The Federal Reserve has been buying mortgage-backed securities and buying treasuries to help keep rates artificially low to spur the economy. So the Fed was in their tapering plan, meaning they've been slowly decreasing that support. October was the next leg lower, and they're virtually buying no mortgage-backed securities or treasuries at this point, and they're even letting some of their portfolio of what they own sell off into the market. So now we've lost the biggest buyer of mortgage-backed securities, the Federal Reserve, out of the market. That definitely increases volatility, and generally it's going to push to higher rates because anytime rates were starting to increase, the Fed could go in before and buy more rates to help drive the prices down. So that's a major factor. The unemployment picture. So the Fed's mandate is keep inflation under control and keep a strong labor market. We've got a strong labor market. We've had a strong labor market. I mean, we hit record low unemployment today, so the labor market is strong. We've got the inflation. So inflation, depending on which measure we talk about that, it's been running around or above the Fed's target of 2%. For quite some time. So we've got, the Fed decreasing buying, we've got inflation at their target or maybe a little above it, we've got a strong labor market, and we've also got great economic reports. I mean, every report we've received recently has been great, showing the economy's expanding, the economy's improving. All of those things can lead to possible inflation, and rates are reacting to that, or investors are driving rates higher to react for the possible upcoming inflation. That's the same story we've been talking about. Just a lot of things came in this week, and investors got spooked. And now we've hit some technical levels in rates that are going to be hard to come back down from. So it'll be interesting to see in the next coming weeks, but this might be a new normal range for us for mortgage rates. Now, if we take back a big picture, we look historically, you figure if you look back 30, 40 years, and 8.5 interest rates, the average, we're still well below that. So rates are still great, but in our recent few years, we're hitting rates this is the highest rates we've seen. So that's this week. I hope it wasn't too brutal and I didn't even cry, so that's a good thing. If you have any questions about this, want further clarification, please reach out to me. As always, I appreciate your feedback. I appreciate you watching, and I'm here to help. Thank you.